officials have had to slash the number of ships allowed to pass. Shipping experts warn the problems could get worse. This could cause shipping costs to jump, cut Panama's annual revenue, and increase greenhouse gas emissions due to longer shipping routes. Tyler, not to mention the fact that we're already seeing the impact on produce here. If you looked at blueberries lately, like $10 a pint in some places, if you can even find them.
Yeah, no, it's absolutely true. It's crazy. All right, thanks, Bertha. Yields a little bit lower today, but the 10-year still hovering near multi-year highs, and that is sparking concern about the growing costs of servicing the country's debt as the government continues to spend. Here's what Duquesne's Stan Druckenmiller told CNBC Squawk Box.
What's up? I'm back, ladies and gentlemen. Yes. We are back. All right, let's see what we gonna have.
As outlined in the Wall Street Journal editorial this morning, my father told me, if you're in a hole, stop digging, Stan.
Well, that fight over spending is what has America facing the threat of a government shutdown yet again.
And joining us now to discuss is Senator John Kennedy, Republican from Louisiana. He serves on the committees for appropriations, budget, banking, and judiciary. Welcome back, Senator. Good to have you.
Good to be here.
I'm going to start, if I might, with sort of the same question I asked Representative Sherman just a few moments ago.
What it do? I did catch a trade on ES short. So this movement right here, I ended up catching this. Just before getting off, I did tell you guys that it looked like we were topping out, and I caught a nice break, the break of 42.40. Took profits at 42.30, and now looking for a potential pop back up to create a double top and then reshort again.
You have to consider all Americans, and many Americans, many people in my state have to sell blood plasma in order to go to the grocery store. Yes, inflation has fallen, but we all both know that's disinflation. That just means it's going up less rapidly. Prices have not fallen.
Fair point.
Unless we have a recession, a fairly serious recession, these high prices are going to be with us for the rest of our life.
What was telling me that it was topping out? I was looking at the 5-minute time frame, and on a 5-minute time frame, just based off of how we had already ran up. So right here, 5-minute time frame, we ran, we dropped, and then the follow pop couldn't exceed the previous high made.
That's a good thing. But I think what has skewed that was the pandemic, and there was
So this right here was what was letting me know that we probably might have topped out. But also looking at the 1 hour time frame, I mean, we had 1, 2, 3 hours of just full on buys, no real retracement, along with RSI and stochastic had reached overbought territory on the 1 hour time frame.
So if we turn
So once it broke below 42.40, I was like, okay, let me try it out.
Just talking to Congressman Sherman about how exactly that's going to happen. Not clear if these IRS cuts are the right way to try to offset that spending. Is it important to offset that spending, or just more important to get the aid out the door?
Well, I'm glad to see somebody is thinking about offsetting the spending and not just borrowing more money. Looking at, I think, the way most Americans look at it, there are two major issues right now. They're not the only issues. Number one, the biggest domestic issue is inflation. And the president does not have a plan to deal with inflation.
Yes.
Because the Fed does. But you can't really get inflation under control.
Yes, we bet.
On the monetary side by the Fed, and the fiscal side by Congress. And the reason that the president doesn't have a plan for inflation is because it would require him to spend things. The biggest international issue, obviously, is parts of the world are on fire. And it is clear to me that China, Iran, Russia are working together. Their goal is to have China dominate the Indo-Pacific and Sub-Saharan Africa, have Russia dominate Central and Eastern Europe, and have the Ayatollah and Iran dominate the Middle East. And that is
you get anything for us over there, Queen?
So let's talk about the question of sending military aid to Ukraine and to Israel at the same time to fight Hamas. Do you expect that those two items will move together through Congress, move separately through Congress, and where specifically are you on sending more military aid to Ukraine, and aid to Israel?
Good question, as usual. Right now, present company excluded, most members of the media on Capitol Hill are interested in talking about process because process is sexy. You know, who's mad at who's up, who's down, who's got a leg up. I'm more interested in substance. We don't know what's in this bill. We know it covers Taiwan, Ukraine, Israel, the border, and a whole bunch more domestic spending. But we don't know the details. And I had a conversation.
This come out.
This is a supplemental. And I had a conversation with Mitch, with Senator
But you copping a new Hermes bag or a new Hermes shoe?
Okay, we need some language that everybody can look at so we can look at the substance. Forget the process for a second. Okay?
I was just about to say you catching a Birkin. Oh, but you needed.
The Senate. I don't care.
Okay.
I mean, I'm interested in the substance.
Birkin.
Dollar figures tell you the substance. I mean, it doesn't sound like there's that much in the shadows here. If it's basically as described for Israel, Taiwan, Ukraine, the border.
Okay, all right.
So what's the holdup?
Putting those funded payouts to the work.
Border security. Well, define border security. Some of them, some presidents define it as securing the border. Others define it as buying more welcome mats. Now, look, how they're going to spend this, how much of the money for Israel, for example, is going to go to humanitarian aid. I'm not against helping innocent people. I want to help innocent people. But I want to know how much money Europe's putting up, how much money the Arab League's putting up, how much money the EU's putting up.
200 to go for your payouts or to pass another one?
What the assurances
This is my
are that the
shades,
money
man. I
we
gotta get
give
my
for
shades on, yo. This
humanitarian
market's about
aid
to
doesn't
drop.
go into the pockets of Hamas. Now, that's just one example out of about 100 questions I have. And again, while the process is cool to talk about, and I get it, it's important. The substance is a hell of a lot more important.
I want to come back to a point of substance, and that is, do you see yourself
Feel it.
and the majority of the Republican
Payout, nice. That's what's up.
favor
Get
of
it.
additional military aid for Ukraine?
Conceptually, the answer is yes. And I say that conceptually because, Tyler, we haven't seen the details. And the border security is important. It's going to impact that vote as
You
well.
got this. You got this. You better take those payouts.
Theoretically,
And that goes for anyone that is funded. I know we get caught up with wanting to pass, multiple accounts and just get a certain amount in funding. But once you get funded, make sure you trade that sucker and you get some payouts.
Are you both Louisianans?
yeah, Mike's a great guy.
Is that you think it'll help?
I'm delighted. He's whip smart. He's humble. He's consistent while being self-confident.
Can he do president?
He does great impersonations. He does great impersonations. And let me tell you something. He's a nice guy. If you don't like Mike Johnson, you don't like border collies or golden retrievers. He's just a really nice guy.
Can he do business with President Biden and vice versa?
I don't know about President Biden. It's not just President Biden. It's his people. If I were Joe Biden, what I'd do on this bill, I'd help negotiate a border security bill.
What are you
And I
doing?
would, if I were President Biden, and after I did that, I would bear hug it and French kiss it.
All right.
I would say, because he's in trouble on the border. He needs to show the American people that he doesn't believe in open borders. But I don't know what the White House will do.
All right. We have to leave it there. Senator, always enjoy it.
Could I say French kiss on the air? That's okay.
You did, and we're happy you
It's too
did.
late now.
Yeah, all right. Thank you, Senator John Kennedy. Louisiana. Appreciate it.
Thank you.
Let's get a quick check on stocks, which are losing some steam ahead of the Fed decision top of the hour. Dom Chu has a closer look. Dom?
Right in between the trading range, the S&P's Kelly up about 1/3 of 1%, 4206. 42.43 is that 200-day moving average. That the Dow Industrials up about 0.1%.
So
The
let's
S&P
go.
500 again up 1/3 of 1%. The Nasdaq up 1/2 of 1%. Check out 10
All right, we got about 11 minutes to go. 11 minutes to go.
Remember at the cycle highs right now. 4.812% there. Check out the bank stocks as well. They're always
Feel free to ask any questions if y'all have any.
Bank of America, Citi, PNC Financial, Morgan Stanley, all showing some signs of weakness, except Morgan Stanley up 1/10 of 1%. And then to cap things off, check out what's happening with big technology stocks.
Oil with the
Always
drip.
a little bit interest rate sensitive. Watch Apple, Microsoft, Alphabet, Amazon, Nvidia, all posting gains right now. And Nvidia is back. Kelly, Tyler, about that $1 trillion market cap mark. I'll send things back over to you.
416 hangs on to the four-handle top banks. We're minutes away from the Fed's decision on rates today. We've heard from some key lawmakers. What are markets pricing in? Our next guest says both investors and policymakers have to adjust to a new framework, and they still have not. Dan Clifton is here. He's partner and head of policy research at Strategas, a Baird company. Dan, welcome.
Tesla's back over 200. It really needs to get over 202.
Three headlines today. The Treasury Borrowing Advisory Committee, the Ukraine, Israel aid, and the Fed decision. They're all interlinked. And the reason is that once the Berlin Wall went down, the framework changed here in Washington. Low inflation, low interest rates, low debt servicing costs, geopolitical volatility. All of that is being thrown out the window right now. And the dividend that we received from the Berlin Wall falling is now starting to reverse itself. So now we got high inflation, higher interest rates, higher debt servicing costs, more austerity, and the people who don't like America are challenging us geopolitically and trying to stress us out while our budget is strained. And so that's why you see these big squabbles going on. How should we fund Israel? Should we pay for it? And you know what? We have Treasury Borrowing Advisory Committee funding today, borrowing estimates. It doesn't include $100 billion for Ukraine.
9 minutes to go, and we're catching a little top.
We're going to have to adjust.
I think that's so well said, but one of the interesting wrinkles in this is the reason why Treasury wants this higher than normal cash balance is also because
Right now, the main one that I'm using is
You know,
Apex.
it's because of the deficit, but it's also because they need higher reserves than they once did. If we could get to this idea of no more shutdowns and no more debt ceiling fights, they might be able to reduce that and actually take some pressure off of the market right now.
And I would add to that, though, if we have a geopolitical
Apex
crisis,
is the main one I am using.
event, we need that cushion there. So it's more than just government shutdowns and debt ceiling. They should have a cushion. The question is, though, should we be running $2 trillion
How
deficit
many?
with a 3.5% unemployment rate? The federal spending is 24% of GDP. We got to see that come down because we'll never have enough tax revenues to be able to meet that. And so that's the challenge for us. And so for 25 years, we've been able to cut taxes, increase spending. Everybody was happy. And now we're starting to have the debate. The candy has to be offset with the spinach, and it's really hard to do politically, and that's the fight we're having. And we call this budget trench warfare. But you know what? The House is going to pass a bill. The Senate then has the option to do what they want to do, and then they got to sit in a room and get together. That's the way we've always done it. And there's this fear this morning about, oh, the House is going to do this, and we're all over the place. We will get this done. We will get it done. It won't be easy. It will actually be quite ugly, but I do think we'll get most of this done.
Likely there will be a government shutdown in the middle of the month.
So I'm at a consensus on this. I don't think there will be a government shutdown on November 17th. We just had a House of Representatives shut down for 22 days. That was our show. So now we're going to go out. We're going to say
Right now, I'm debating on taking a small short on ES, the micro side, and then once I get confirmation, I'll either close out the trade or add to it.
CRs instead of the ability to go through all the bills one by one.
Exactly, but they need time to be able to pass those appropriations, so they want to build in time. They don't want to be jammed up. But over the last 36 hours, there's been
Something like that. They're like, yo, we can't be having this dude do this.
Political capital on Israel, Ukraine, border security. That by the time that's done, then you got to get to the CR, and it's going to be tough. So that's why I say we're entering budget trench warfare. Each fight in itself is going to be a fight, and we got to just kind of resolve and work through this.
All right, Dan, thank you very much. Dan Clifton, we appreciate your time.
Thank you for having me.
Thanks for coming on.
We're about less than 10 minutes, just 7 or so minutes away from the
yeah.
Fed decision. Chair Powell's press conference is after that, beginning at 2:30 p.m. Eastern time. That's sometimes even more
6 minutes to go. 6 minutes to go. Come on. What kind of size do you do? Contracts, I don't exceed 4 contracts. So NASDAQ, especially, well, so on NASDAQ, I don't exceed no more than 4 contracts. Well, no. So 4 contracts. So yeah, so I don't exceed no more than than like 4 contracts per account. So collectively I'm doing 80 contracts on NASDAQ. On ES, I do about 10 contracts per account. So we're looking at about 200 contracts overall. But I can max out, the max on that account is I can do like 35 contracts overall. So when I do 4, 5, 10, I'm nowhere near the max amount. Yeah.
With ice.
Welcome back to our special coverage of the Fed decision. I'm Tyler Matheson, along with Kelly Evans here in Washington. Just a few minutes away now from the release of the Fed's decision on interest rates, about 4 minutes to be exact.
Okay.
We'll see what our panel
157, 157.
Before that, you see the Dow hanging on to about a 0.2%
Let's go,
gain.
let's
the S&P is
go.
up 0.4,
Get
and the
ready.
Nasdaq is up 0.6 today.
Get ready.
The 10-year note right around on the nose at 4.80. We dipped a little below that this morning after some weaker than expected data, especially that weak ISM manufacturing number. It's very forward-looking. It's very market-sensitive. The ADP employment report was also a little bit light on private sector hiring. That said, the JOLTS report also showed some strength. So anyway, the 10-year note 480. As we get ready to hear from the Fed, let's get to our panel. David Kelly of JP Morgan Asset Management, Kristen Bitterly of Citi Global Wealth, Jim Karen of Morgan Stanley Investment Management, and here back on set with us is Paul McCulley, former PIMCO chief economist. Welcome to all of you. David Kelly, what's your take?
Yes. Just a small 1 contract on the micro. So I'm only in on the micro. My entry is 42.2975.
Get rid of the scent at the close about how labor markets weakened, but overall, I think they're looking at an economy that is strong.
So being that I'm in a micro, I can literally afford like a 30, 40 point spike. But I have my stop at the high of the day. If it spikes above that, I'll take the loss, and then I'll look to catch either the reversal or a continuation.
Door left open for the future. David says they're done. What do you think?
I would agree with David on this. I think that it's going to be a hawkish pause in terms of leaving some of their optionality open. But at the end of the day, when we look at the
2 minutes, 2
economic
minutes
data that we're receiving, yes, it's hot, but there's also signs of some cracks and some weakness. The ISM report that we saw earlier this morning. So I think the most interesting part of today is really going to be the press conference and digging into how they're viewing inflation and how they're viewing kind of the trajectory for longer term rates.
Although, Jim Karen, one of the fascinating things about the last meeting was that the chair was his usual kind of hawkish self, and then the minutes came out and were more dovish, and then the beige book came out and was even more dovish.
So I think the Fed is likely not to do it.
All right, we have
But I think that they want to.
less than 30 seconds, so volume up.
So look, I mean, the latest run
Let's
of
keep
data
it
that
quiet.
we've had, and I know it's for the third quarter, but it does give us momentum into the fourth quarter. But the third quarter data was pretty strong. So it's really a question of, are things cooling fast enough? Will inflation get down to the levels it needs to get to? So if we look at CPI, headline CPI was still printing, a hot 3.7%. Target core PCE for the Fed is around 2. We're still
5
running above those
seconds.
levels. So the question for me is, do they use this do they use this meeting today to actually suggest that they may hike rates possibly in December? Now, I don't think that they will.
Little pop.
But I think there is a risk that the Fed comes out a bit more hawkish just given the recent run of data.
Come on.
Paul, we got 1 minute. As the Giants proved last week, a lot can happen, and not all of it good. Is this one of those times where doing nothing is actually doing something?
Absolutely. Absolutely. We're at 5 3/8 for the Fed funds rate. The entire yield curve is below that level. So the Fed's tight.
Go.
And if the data's stronger or the inflation is disinflationary as they want, there's room for the marketplace to continue doing the Fed's work. The Fed's in a good place.
And so the Fed chief is probably happy that bond yields are higher.
Yes, yes.
He's quite content with that.
He likes the fact the market's not fighting him anymore.
All right, folks, we're going to have you all stick around as we get ready now for the decision from the Fed. Widely thought that there will be no change. Widely thought that, the door might be left open. Let's go to Steve.
Let's go.
Unchanged. Federal Reserve leaving the interest rate unchanged at 5.25% to 5.5%. It's the second meeting in a row. The Fed has been on hold. First time it's done so since early 2022. The Fed, however, is still determining the extent of additional policy firming, suggesting that there is still a hiking bias in the statement and among the committee members. The committee saying it remains highly attentive to the inflation risk language precisely from the prior statement, as well as saying that inflation remains elevated. The economy was upgraded just a bit, saying it's now it grew at a strong pace in the third quarter compared to a solid pace in the previous statement. Job gains were also upgraded just a bit, saying they moderated instead of slowed in the prior statement. The statement also now mentions tighter financial and credit conditions, adding the word financial likely will weigh on the economy. That perhaps is a mention for the rise in the 10-year yield and other yields that have affected the economy. The decision was unanimous, and now we have a question, by the way, very, very similar statement, only a few words tweaked. Does the upgrade to the economy now perhaps put additional rate hikes on the table, or is the idea that this statement is so similar to the other one that led the Fed to pause? Does it lead you again to think, well, you know what? They're teeing up another pause here. I guess we may have to wait for the press conference to find out.
Fascinating.
Yeah.
There's some of the market reaction. Steve, stick around as we bring our panel back in. And Bob Pisani and Rick Santelli also join us. Rick, I'll start with you as it looks like we're seeing yields move lower.
Yes, we're moving lower, whether it's 2-year, whether it's 10-year. From 3-year all the way out to 30, we have double-digit drops in yield. But the real key is, why are yields dropping? Now, as we look towards today, obviously at 8:30 Eastern, we had a whopping $2 trillion less in the refunding package of 3s, 10s, and 30s, and I truly doubt whether that $2 billion less is going to make that much difference. But there was a psychological issue there, and I do think that we have brought in many buyers over the last couple of days with respect to treasuries. They had a failure to launch in 10-year with a close above 5%. And now it's a neon sign. Many are moving towards the long end and looking at what they consider juicy yields. But I think that the Fed has a real problem here. I continue to go back to the notion that we spent $5 trillion during and post-COVID. That money isn't all spent, and it's going to continue to potentially give us a sugar buzz, which makes the Fed's job that much more complicated, because we all know sugar buzz growth doesn't lead necessarily to organic growth, which is sustainable. And I'll leave with one final thought, that we now have $307 trillion of global debt. Okay, that's per the Institute of International Finance. CNBC did a great write-up about that.
I'm going to be on until Fed Pulse finishes speech. So probably until like 3. So I'm only going to be on until like about 3.
all the global metrics, we are definitely slowing. And with regard to inflation, hey, let's say that it's peaked. But one area that's going to remain sticky is going to be electricity and energy, whether you're in Europe, whether you're in Germany, or whether in the U.S. That transition is always out there. So we're going to have some inflation, lots of energy
Can we
inflation.
get
We're not going to have
4220s?
disinflation,
Come on,
as
baby.
Tyler always brings up, bringing us prices back to where they were. And 307 trillion of global debt. To me, it's going to be an issue that continues to keep interest rates mostly higher, even though right now it seems to me that if we close under 4 3/4 and 10s anytime this
There
week,
you
I think we
go.
can go down
There you
another 30
go.
or 40 basis points. But in the grand scheme of things, I'm still looking for much higher rates.
All right, let's go to Bob Pisani and see how equities are reacting to this decision by the Fed. Bob.
Modest move up in the S&P, 4 or 5 points here. Not much of a change in the statement. It says job gains have moderated. It said job gains have slowed in the prior meeting comments. I see here, Fed still determining the extent of additional policy firming.
I'm
So
looking to
modest,
add,
hawkish bias.
but I
think
just
the
want to
problem
watch
for the
this
market now
15-minute
is
candle
it's
close.
basically
I want to
positioned
see
in
how
a
this
nice way.
15-minute
It's
candle
assuming
closes for me
that
to either add
are essentially
to my short or just close it out. I'm in at 42.2975, so I'm not down much right now. Just a couple bucks.
For them to be enabled to essentially stop raising rates and to start cutting in the middle of next year. And that's sort of the problem the market's got right now. It's potentially wrong here. We did have some good news today on the ISM manufacturing, supportive of generally somewhat weaker economy. So you've got to have that, the ability to show that the economy is slowing down here. So I think Powell's probably going to continue to reiterate the economy is resilient. Pricing pressure is still very prevalent, and they're prepared to raise if the evidence does not indicate they're getting closer to their 2% target. That's
Thinkorswim is a bit slower than it seems to be moving slower than Tradeovate.
Among this group feels that the Fed may be more aggressive. Is there any? Do you agree with what Bob just said, that another rate hike is very much on the table, and maybe this decision and this statement makes it even more so?
Hell yeah, it's on the table.
I think Bob's correct. I'm in its camp here. Look, I mean, the risk in the market is that the Fed continues to hike interest rates. I mean, is it likely that they keep rates higher for longer? Yes. And yes, bond yields are higher. Yes, the economy's cooling. That kind of misses the point. Is the economy, is inflation falling fast enough, and are they getting to target fast enough? And the question is that it might not be. So all I'm saying is that when we look at probabilities for the Fed funds, rate to move in December, it's
Thinkorswim is lagging, but Tradeovate is moving pretty well.
50%. And I think that the Fed would be happier making the market think that. Now, that wouldn't be good news for equities. That wouldn't be good news for the bond market. But that's part of the solution for the Fed.
There we go. Come on.
Financial conditions have
I
gotten
just want
tighter.
42.20, man. Give me 42.20 or sub 42.20s. We're good. Slightly in profits right now, fluctuating between break even and profits.
But are they willing to risk inflation re-accelerating, becoming unanchored, and then having to come in more aggressively later, or do they want to take out one more insurance rate hike? I'm just saying the odds could be closer to 50-50 for a rate hike in December, and we shouldn't misprice that risk.
And I think everyone has a different sense, perhaps, Jim, of what insurance is these days, depending on your view of where the economy is in 12 months. Let's bring Steve Leisman back in as he's been combing through the statement. Steve?
I like what Jim said there, that there is definitely the risk out there. There's a certain bias in here that is basically an unchanged bias. They added a little bit on the economy, but they also added a little bit to the downside when it came to financial conditions. I think that the story here is that they noted that their
real sluggish price action, not what I was expecting.
And so to the extent that Bob Pisani just talked about getting good news, and I don't like using that phrase when it comes to weaker economic data, but it was good news for those who are concerned about the Fed in the ISM manufacturing, also a step down in the ADP numbers, then that tends to rule out an additional rate hike. So I think we are indeed data dependent here when it comes to what the Fed is going to do next. And if that forecast for a weakening economy is the right one, which is the one again on the street, then I think we may have a third month of holding here.
So, David, let me ask you: is there anything in here? And you heard what Steve just said. Is there anything in here that changes your view that the Fed is done?
No, I think it confirms my view. I think the two things. One, they didn't have to say that job gains were moderating because, frankly, we added 336,000 payroll jobs in the last print. That's not moderate at all. And so the fact that they said moderating suggests a little dovishness, but much more important, this slight nod to the fact that financial conditions have tightened with those higher interest rates. It's kind of like that's the last additional rate hike they might have done, or it's in the place of that. So to me, it says we acknowledge that, looking backwards, the economy's been strong, labor market's been strong, but we acknowledge that there's even more pressure in the economy coming from these higher rates. They're not willing to claim any progress in inflation yet. I think they'll see some more progress in the months ahead. But overall, this makes me feel more likely. I think it's more likely the Fed is in fact done, and they won't have an excuse to tighten further.
Kristen, is this the hawkish pause you were expecting, or is it a more dovish one?
I think the way the market is reacting right now is a little more dovish, but we will see when we get to the press conference.
Not liking
I
this
think
at
ultimately,
all.
though, when we're talking about this question of whether there's going to be one more 25 basis point hike,
I'm still going to give it a few. We're in profits now. We're up 2 points.
And I think the key question is really the how long question.
Come
And so
on.
what we're going to look to in terms of the press conference is
If
really
at any
type
point
of
you
signals
get tired
around
of
how
holding
they're
this
viewing
trade and you
inflation.
just want to
Because
lock your
when you look
profits
at
in,
how
feel free to
inflation is
do
breaking
so.
down, yes, you may have, it's tough to see that path to 2%. I think you can see a path to 2.5%. But really, when you look at the underlying components, everyone's focused on services, they're focused on owner equivalent rents. When you
Okay,
look
let's
at
go. 3
non-shelter
points and counting.
services, you're
3
actually
points and
within the
counting.
historical mean. So you're around 2.8%. All of the other components are actually 2% or below. And you have that owner's equivalent rents with a lag. So there is an argument that the composition of inflation is getting you to a trajectory where you can see a path, and you can see a path to that 2.5%. Not quite at the Fed's target, but certainly something that we want to hear more commentary about.
Come on, stop playing
Paul
with me.
McCulley, bring us across the finish line.
I agree with a lot of what's been said here, that the Fed did make an acknowledgement that financial conditions have tightened. So that's what we've all been talking about.
Excuse
They
me.
also acknowledge that the economy has been stronger than expected. So you put those two things together, and effectively it says they're on hold. They also still have the bias to another hike. But I'm with David Kelly. They're not going to do it. But the bias itself serves a purpose because it keeps us talking about
vigilant.
Keeping us vigilant. It keeps us from wanting to have a big rally in risk assets. So I think just the bias itself
sideways.
is useful, and reminds me of 60
holding.
years ago
Yep.
when my dad would say, "Don't make me pull over this car." Essentially, that's what Jay Powell is saying. Don't make me pull over this car and do another
Still
hike.
holding. I'm still holding. Maybe
the last statement they had cited tighter
we'll see if
credit conditions.
once
This time they cited
once
tighter
Powell
credit
stops
and
speaking,
financial
if we get
conditions.
that
What does that
full
tell you,
on
the
drop.
inclusion of that language?
It says that they're getting better transmission of tighter monetary policy. Remember, they just control the rate, and then it's transmitted to financial conditions, whether it's in the banking system or in the financial markets. So they're getting better transmission. And I think that's hugely important. If you can get the same degree of tightness in the marketplace and the banking system with an unchanged Fed funds rate, then hallelujah. You're getting what you want, which is tighter financial conditions, and the bias keeps the market from wanting to front run the Fed on the dovish side.
Steve, maybe this betrays my naivete on this, but is there any surprise in the fact that there is nowhere in this statement are geopolitics or world conditions or the Israel-Hamas war mentioned whatsoever? Would have been way out there to have included a reference to it?
I think it's not a surprise in that all of my reporting, and I think probably the guests that
Okay,
you've been
we're looking
interviewing,
better.
Tyler,
Looking better. There we go. Come on, follow through, baby. Yes, follow through.
line from
Keep
the
it going.
tragedies and the hostilities taking place in the Middle
Come
East
on.
to the U.S. economy right now. Ukraine has been going on for a long time. That level of violence remains what it's been. What's happening in Israel and Gaza is new, but it hasn't had a market effect on oil prices. So to be completely clinical about awful human dramas, there is not a line. I did want to mention, Tyler, what's been happening in the Fed funds futures market, which is pretty interesting. A very slight bid, now a 33, 34% probability now of that rate hike in March. So what they did is they took their anxiety about January, possible rate hike, and maintaining this could be just a hedge, but there is something of a bid out there. But more interesting, what's happened here is that they took what was sort of a 50% probability of a cut in June, and now they kind of skipped June, they skipped July, and now it's September with a cut. So what's I think happening here is there is a trade-off.
There we
and
go.
I think
Come on.
Powell is trying to make this trade.
Break
Says,
it down,
I
baby.
will trade you that next hike. I don't need to do that. I do need you to think about higher for longer and price that in. And I think that's the trade the market is taking and bidding right now.
Rick Santelli, anything you'd add?
No, I agree with much of what's said, but I think as I look at the markets, here's what I see. I see virtually unchanged on a 10-year, maybe a basis point lower on twos, which means that the Treasury complex pretty much ignored or didn't see anything new to worry about. Equity markets are darn close within 10 points, the Dow Jones. So what I see is that there are many, and I know this
There
was
we go.
discussed
Come on. We
earlier,
need
there's many
4220s,
tightening
sub
Fed doesn't
4220s.
affect.
Come on,
There's a lot of
baby.
boomers out there that don't need credit. They don't have a mortgage. They're most likely not going to look for a mortgage. So we can't even get at that crowd. And I think that all the rest that are affected are going to continue to be consumers that don't necessarily participate. I do think that retail sales is going to start to slow down a bit. And I think some of the metrics for GDP were distorted by inflation. I think the Fed has done a pretty good job as of late. And I also do agree they're done. And I guess I'm a glutton for punishment, Steve, because I'll bet you another tranche of cheeseburgers that they don't have another hike in the cycle.
David Kelly, why don't you wrap it up for us here? Are you now persuaded?
There we go.
that
Good,
they are
baby.
done?
Good.
You've
Go,
said that
go,
before,
go.
But
Yes.
that higher for longer is the regime.
Yes,
Yeah,
let's
I mean,
go.
If they follow their normal playbook, they're going
Let's
to wait
go.
too long to cut rates.
Come on. We need
But
sub
that's how
4220s. We
it
need
works. So I
sub
think
4220s.
At some stage next year, we might see some economic weakness. We may trip into recession. The economy's going to be growing slowly anyway. But my guess is that when they cut, people are going to say, you waited too long to cut.
Yeah, I remember you saying this 2 years ago, David. You said what happens here is they wait too long to start, they go too far and keep it there, and they stay too long before they pull away the regime. David Kelly. Oh, yeah, David Kelly, Kristen Bitterly, Jim Caron, thank you very much. And we are minutes away, and Stephen and Rick as well. Minutes away from comments from Fed Chair Jay Powell. We'll get some more analysis after a quick break.
Come on, baby. Right back up. Right back up. It's like slowly inching lower, slowly inching lower. Mm. Mm. Right back up, right back up. Let's see.
85.55.
Welcome back. The Fed leading interest rate unchanged for the second straight time, saying inflation remains elevated and they've got their eyes on it. Let's get some reaction from Dennis Lockhart, former president of the Atlanta Fed. Paul McCulley, former PIMCO chief economist, still with us to participate in our conversation. Mr. Lockhart, welcome. Good to have you with us. What do you think?
Well, I've been listening to the commentary up until this moment in this half hour, and I think people have it mostly right. David Kelly thinks they're done. I would put this nuanced spin on it. They're done if conditions allow them to be done, conditions that we really cannot predict very well for the coming months. But if their current outlook holds, there's a good chance they are done. But they're not done because they've made a decision to be done. I think
Pop back
Powell and
up.
company will keep their options open. And in the coming press conference, I doubt you'll see much of a signal about what they'll do in December.
We've had, Paul, this setup before where market is almost unchanged after the statement. Then the press conference begins. He says something relatively hawkish, and off we go, for that day or sometimes for the next several weeks. Now, last time was a little bit of a break from that pattern, but point being, what should we be on the lookout for in terms of his remarks when he starts in about 10 minutes?
I think a lot of the questioning is going to be on this whole issue.
Okay.
How close are you to sufficiently
Getting closer to Powell speaking.
language in Fed speak that they want to get to sufficiently restrictive, and then they want to hold there. So it's really a two-pronged sort of issue. Are you sufficiently restrictive? And I think he will fudge on that one. And then the issue is, how long do you plan to stay there?
Okay.
And I think, as Dennis was saying, is we're going to stay there until we get evidence that we don't need to be here anymore. So I think that, essentially he's going to try to encourage the marketplace to hold the back end of the curve up in anticipation that long is long.
Mr. Lockhart, why has the economy remained so resilient in the face of what have been very aggressive?
Absolutely. We already know it wouldn't be a FMOC day if they did not play with us a little bit.
Well, I think the basic is one of consumer spending being held up by good employment outlook on the part of households. As long as people feel they're going to be employed and they have some income security, the American consumer will
Not for nothing. Probably maybe should have taken those profits at the 42.22 area. It's like so close to breaking 42.20.
Household has both perhaps the balance sheet, the savings to continue spending still, as well as a positive outlook in terms of income.
So just to stay on this point, Dennis, for a moment then, do you think that they can convince the markets to stay up here at sufficiently restrictive for a pretty long period of time, or does it still depend on things like the jobs report Friday morning and how that evolves?
In my experience, it's very hard for the committee to shape market outcomes. I think the committee is more of a mind to simply set policy at the policy stance they think is correct and hope the markets are aligned and hope the markets will help. But the idea that they can say something in a press conference or in a speech or in a statement that actually produces an outcome in terms of bond pricing in the markets, I just don't think they have confidence they can reliably do that on an ongoing basis.
If you could ask President Lockhart one question, and now's your chance. I might even give you a second question. It's a good question. What would you ask? Talk right to him. Talk right to him. There he is.
I would follow up on the comment that he just made when that the committee itself can't manage forward expectations on Wall Street very well. I would certainly agree with that. But my question is, can the chairman do that? Can the chairman do that?
I think the chairman can certainly have a big influence. The chairman speaks for the committee. When the chairman speaks, it's entirely different than, for example, when the presidents speak. But at the same time, we live in a world in which markets are influenced by all kinds of things. that may not be anticipated in what the chairman has to say. So I think there is a limit to how much confidence the chairman and the committee have in trying to actually produce a market response or market outcome.
How soon, Dennis, do you think it will be before we get to that 2% inflation threshold that the Fed keeps talking about?
5 minutes till Powell speaks.
Notice in the, at
Come
least
on,
in
dump
September
it for us.
SEPs that the committee appears to be pretty patient, and that it's in the out year that they get close to the 2% target. So I don't think it's anytime soon, and I am prepared to believe that the last mile, as it's called, is in fact going to be difficult. One of your earlier commentators spoke about getting to 2.5%, but getting from 2.5 to reliably around 2% could be a really long pull.
Yeah, looks
so
like
far,
we'll
I think
see.
the committee's prepared to be patient and not over tighten in order to get there sooner.
Interesting.
All right. Dennis Lockhart, thank you very much. We appreciate your time. As always, it's great to see you. Paul, you're going to stick around. You behaved yourself very nicely. You get to stick around till the chairman comes on.
We're just a couple minutes away from that event. Chair Jay Powell's press conference begins 1:30. We'll take you there as soon as it begins. More of our special on the Fed decision after a break.
Okay. Still in the same area, same range, same area. I know you wanna drop, baby girl. Stop playing. We had a highs, we popped, we couldn't get over, but again, anything can happen when Powell comes on. So keep that stop loss there. Let's see. She going, come on. Come on.
Welcome back as we await Fed Chair Powell. Let's get some final thoughts from Paul McCulley before we let you go. I just want to mention that we haven't really talked about QT yet. And
We get some questions about that at the press conference, and appropriately so. QT is running in the background. They've said that many, many times. But essentially, QT leads the Treasury to have to issue more duration to the marketplace. And everyone's been wrapped around the axle about the deficits and the auctions, all of that sort of thing. And essentially, QT operates in the same direction as a larger deficit. In fact, the Treasury's got to fund not just the deficit, but effectively the bonds that the Treasury, that the Fed is not rolling over.
Right.
Which leads to an increase in the term premium, which we're all focused on now. So I think QT is going to come back into the arena as an important topic of discussion. I really do.
You know, and I guess I'm trying to figure what would be the most elegant way for them to achieve their monetary policy goals at this point? Doing more of it, doing less of it, more interest rate hikes, fewer hikes, trying to get the curve to the balance sheet?
I don't think there should be
1 minute.
around.
Give me just
I
a
think
second.
having it not on
Paul's probably going to be
talent,
late to
but
come
in
on
the
stage, so give me like
background
2 minutes. Be right
important.
back.
reflecting higher mortgage rates.
All right, ladies and gentlemen,
Higher
still
interest rates
moving
also
up.
appear to be weighing on business fixed investment. The labor market remains tight,
Stop
but
loss
supply
might get
and
hit.
demand conditions continue to come into better balance. Over the past 3 months, payroll job gains averaged 266,000 jobs per month, a strong pace that is nevertheless below that seen earlier in the year. The unemployment rate remains low at 3.8%.
Once he's done, I'll go over something that he said. Like, the Feds are downsizing their exposure in the market. I hope you guys caught that.
Particularly for individuals aged 25 to 54 years. And immigration has rebounded to pre-pandemic levels. Nominal wage growth has shown some signs of easing, and job vacancies have declined so far this year. Although the jobs to workers gap has narrowed, labor demand still exceeds the supply of available workers. Inflation remains well above our longer run goal of 2%. Total PCE prices rose 3.4% over the 12 months ending in September. Excluding the volatile food and energy categories, core PCE prices rose 3.7%. Inflation has moderated since the middle of last year, and readings over the summer were quite favorable. But a few months of good data are only the beginning of what it will take to build confidence that inflation is moving down sustainably toward our goal. The process of getting inflation sustainably down to 2% has a long way to go. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored.
It's not positive for the market because that means the feds are taking out money. Like during the pandemic, they bought a bunch of assets. All right, so it's come to a point where they're cashing out, right? And because we're gonna end up having a massive drop in 2024, it only makes sense. As to what I was saying earlier with on DEX, like if you have a long-term position, it's about that time where you start to downsizing it a bit because of what's to come. And because they have so much capital invested in the market, they can't exit out all at once. They have to do it periodically. Yes,
as I noted earlier, since early last year, we have raised our policy rate by 5.25 percentage points. And we have decreased our securities holdings
here we
by more
freaking
than
go.
$1 trillion.
Come on, I'm adding to my short. I'm adding to my short at 41, 42. Give me.
The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25 to 5.5%, and to continue the process of significantly reducing our securities holdings. We are committed to achieving a stance of monetary policy that is sufficiently restrictive to bring inflation sustainably down to 2% over time, and to keeping policy restrictive until we are confident that inflation is on a path to that objective. We are attentive to recent data showing the resilience of economic growth and demand for labor. Evidence of growth persistently above potential, or that tightness in the labor market is no longer easing, could put further progress on inflation at risk and could warrant further tightening of monetary policy. Financial conditions have tightened significantly in recent months, driven by higher, longer-term bond yields, among other factors. Because persistent changes in financial conditions can have implications for the path of monetary policy, we monitor financial developments closely. In light of the uncertainties and risks and how far we have come, the committee is proceeding carefully. We will continue to make our decisions meeting by meeting based on the totality of the incoming data and their implications for the outlook and for economic activity and inflation.
Yes, I do. I do believe we're going to have a massive drop next year.
In determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below potential growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission.
There we go. Come on.
We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Howard Schneider with Reuters. Thank you, Chair Powell, for doing this. To what you referenced the rise in long-term bond yields, to what degree did that
drop, baby. Yes. Oh, let's go. Let's go. Let's go. Let's go.
I'll talk about bond yields, but I want to take a second.
Let's go.
Sort of set
Gimme.
the broader context
Gimme.
in which we're looking at.
Gimme.
If you look at the situation, let's look at the economy first.
Oh, so close to getting stopped out. Do you have a stop? Yes, my stop was at the top of the my stop was at the high of the day, which it got so close. Ooh, let's go. Let's go, ladies and gentlemen.
As for the committee, we are
Oh my
committed
God,
to
that
achieving a stance
42 ad
monetary
was
policy that
on
is sufficiently
point.
restrictive to bring inflation down to 2%.
Oh, let's go. Give
We're
me,
not confident
give me
yet
this
that
sauce.
we have achieved such a stance.
Do you have
So
a
that is the
stop
broader
loss set
context into
or
which this
well, you
strong economy and all the things.
no, I
said,
had a
that's the
stop loss
context
at the
in which
high
we're
of the
looking at
day.
this question.
I told you the high of the day is where I'm gonna risk, but I added at 42, 40, 42, 42.
which have
Let's
contributed to
go.
a tightening of broader financial conditions since the
Come
summer.
on.
As I mentioned, persistent changes in
Come
broader
on,
financial
baby.
conditions can have implications
Don't
for
play
the
with
path
me.
of monetary
Don't
policy.
play with me.
In this
Don't play
case,
with
the
me.
tighter financial conditions we're seeing from higher long-term rates, but also from
We
other
want
sources
the
like
smoke.
the stronger dollar and lower
We
equity
want
prices
the
could
smoke.
matter for future rate decisions as long as two conditions are satisfied.
Marvelous.
The first is that the
Marvelous.
tighter conditions would need to be persistent, and
Marvelous.
that is something that
What
remains to
are
be
we
seen.
up on the
But that's critical.
day?
If things are fluctuating back and forth, that's not what we're looking for. With financial conditions, we're looking for persistent
Not too shabby.
changes that are material.
Not too shabby
The
at
second
all.
thing is that
Huh?
the longer term rates that have moved up,
Oh,
they can't simply be a
let's
reflection
go.
of
Come on.
expected
Come on.
policy moves
Come
from
on.
us.
Can we get 420?
And
We're going to
we
get
didn't follow
420.
through on them,
Can we
then-
get
then the rates
420?
would come
Come
back
on.
down.
4220.
So
Come on, baby.
I
Come
would
on.
say on
This
that,
is
it does
beautiful.
not
You see this
appear that
15
an
minute?
expectation
Oh
of
my
higher
God. This is
near-term policy
lovely.
rates is causing
This
an
is
increase
lovely.
in longer-term rates.
This is lovely. Ladies and gentlemen, and the Dow Jones is dropping. I'm taking the short on the Dow. I'm taking the short on NASDAQ. Let's get it.
Costs for households and businesses, and those higher costs are going to weigh on economic activity to the extent
Keep talking,
this tightening
pal.
persists.
Keep
And,
talking.
the mind's
Give me
eye
this.
goes to the
Give me
8%,
this.
near 8% mortgage rate, which could have pretty significant effect on housing. So that's how I
Come
would
on.
answer your question.
Oh my God! If we can break below 4220, we get under this 200 EMA on the 1 hour.
Financial conditions are
Rap
restrictive
City.
enough to finish the fight. Is
Back
that
to
true?
4200
Yes, that's
even
exactly
we
right.
go. Come on,
To say it a different way, we haven't made any decisions about future meetings.
bro. They're gonna
We
raise
have
it
not
in
made a
December.
determination, and we're not. I will say that we're not confident at this time that we've reached such a stance. We're not confident that we haven't. We're not confident that we
Come
have.
on. We need to
And
get
that's-
under.
that
Ooh,
is
come on.
the
If
way
you
we're
guys
going
added
into
at
these future meetings.
42 with me, we are in
Just
massive
determining
profits
the
right now.
extent of
Thank you very
additional
much.
further
Come on, baby.
policy,
Come on. Come
tightening
on.
that may be appropriate to return inflation to 2% over time.
If I'm you know what I'm gonna do? I'm gonna buy a mic. So when I do these fire calls like this, I'm just gonna drop that. Mic drop. Matt, what's the gift? Let me get a
Thank you
gift.
so much for
Let
taking
me
our
get a
questions.
gift.
I wonder, if you don't raise
Drop.
interest rates in December, would the presumption be that at that point that we should expect the rates are at their
Yeah.
peak, or is there a possibility of restarting
Yeah,
rate increases
buddy.
next year? And are
Yeah,
there any
that's what we
costs in
doing.
taking
Come on.
more
Oh, we about to
instead?
break 4022. Come on, baby. Break it. Yes. Oh, massive profits on NASDAQ short. Let me take some profits on my NASDAQ short.
We're going into the December meeting. We'll get, as
Yes,
you
they
know,
are.
2 more inflation readings, 2
No,
more.
that's not what I'm getting
labor
from
market
it.
readings, some data on
No, it's
economic
not.
activity. And
No,
so we'll
it's
be taking,
not.
and also
No,
the
it's
broader
not.
situation, the broader financial
Okay.
condition situation, and broader world situation.
All
We're
right.
looking at all
So
those
a
things and
little
making
a
decisions.
little breakdown of what
We haven't
Powell
made
has
that
said so far. All
I
right.
would say though that
They're going to continue. They're leaving room to potentially raise rates again, which they are, because the last two meetings before they mentioned that they were going to raise rates at least 3 more times. They haven't thus far yet. All right. And what I caught at the opening of his statement is that the feds are unwinding their position, right? Why else would you be unwinding? When they say unwinding, they are closing out. So they have a position in equities, right, in the in asset classes, and they are lowering their exposure, right? So usually something like that happens is when you're expecting a massive turn, right? So with that being said, that was something that like literally caught my ears to perk up. Like, oh wait, I've already known they've been unwinding, but they just stated it again. They're unwinding their position. They paused this time. Well, they didn't pause, but they left it essentially unchanged. So for December, we may see a hike or the beginning of 2024. So everything that he's saying is just like, oh, they're going to raise rates again. and the fact that they are cutting down their position. And when I look at it from an investor side, if I'm currently in a position, and mind you, they bought asset classes at the low of 2020, right? Like they caught this, like this, it's been a massive run up. So it's only right that it only makes sense to start unwinding, but they've actually been unwinding their position since 4600 on the ES on the spot, right? So the fact that they're continuing to unwind lets me know that a turnaround is coming. So I hope that kind of makes sense, right? Because if you're a long-term investor and then you start exiting out of a position, it's either like on stocks is because the company no longer has good forward guidance. They might have beaten earnings, but they no longer have any good forward guidance, meaning that there's no more growth. If there's no more growth, there's no point in being in it. You have to go and find another investment.
Sometimes it works with lags, of course, which can be long and variable. But ultimately, if you raise raise interest rates, you do see those effects, and you see those effects in the economy now. You see what's happening in the housing market. You're seeing that now. You'll see if you look at surveys of people, it's not a good time, they think, to buy durable goods of various kinds because rates are so high now. I mentioned again, we're getting reports from housing that the effects of this could be quite significant. But you're right. This has been a resilient economy, and it's, I think, been surprising in its resilience. And there are a number of possible reasons why that may be. Our job is to
Let's go. Do I dare short again? I'm scaling back in short at 42.32. Come on, fill me, baby. Fill me. Give me 42.32. I have a sell limit at 42.32. Can I get filled? Don't be a top. Do not be a top.
Progress toward the 2% inflation goal is the labor
Come on,
market
baby.
continuing
Come
to
on.
broadly cool
Fill
off
me.
and achieve
Fill
better
me.
balance. If you
Fill
look at
me.
that, growth, we look at growth insofar as
Come on. You're right there. Just fill me.
We look at that. And we look at broader financial conditions. So we'll be looking at all of those things. As we
I hope you guys took profits. It wins sub 42.20.
if we do reach that judgment,
Nice, charting queen. That's what I'm talking about. When I
Just in terms of the tightening of financial conditions, if that is having some kind of offsetting effect in terms of the need to potentially again raise rates, what then is the potential impact on the trajectory of rate cuts? Could we see those maybe pulled forward or have to see more than
all right, yeah, definitely.
So it's
damn, you always gotta bring your charger, man. You gotta make sure you always have your charger, bro.
At all. We're not talking about rate cuts. We're still very focused on the first question, which is, have we achieved a stance of monetary policy that's sufficiently restrictive to bring inflation down to 2% over time, sustainably? That is the question we're focusing on. The next question, as you know, will be, for how long will we remain restrictive? Will policy remain restrictive? And what we said there is that we'll keep policy restrictive until we're confident that inflation is on a sustainable path down to 2%. That'll be the next question.
They're not gonna let me in. They're not gonna let me in. It's all good.
The question of rates cuts just doesn't come up because I think the first, it's so important to get that first question, as close to right as you can.
Oof. Out.
Steve Leisman, CNBC. Mr. Chairman, I guess I had assumed that there was a tightening bias in the committee. You say in the statement you're looking to assess the appropriate stance of monetary policy.
Bruh, gone. She about to be out of here.
You didn't say
Drop
earlier
it.
that you were sufficiently restrictive.
Drop it like it's hot.
Forecast for
Drop
rate
it
hikes
like
from
it's hot,
most members of the
baby.
committee.
Oh, we about to break.
But then
We
you
about
just
to
said that,
break.
we haven't made a determination. Would you say the bias right now is neutral, that there is no
Come on.
disposition
Break
to
it,
hike
break
again,
it.
and
I
that the
know you
committee
want to break it.
largely has moved off of this forecast for 2 hikes? additional
I
hike.
think it's about one additional.
Yeah.
No, I wouldn't say that at all. I would say, I mean, the language, looking at it here, in determining the extent of additional policy firming that may be appropriate to return inflation
Come on.
2% over
You
time.
know you
That's
want to
the
break
question
it.
we're asking.
So is it right to think of that as a hiking bias is still in the committee here?
We haven't used that term, but it's fair to say that's the question we're asking is, should we hike more? It's not, and that is the question. And you're right that in September, we wrote down one additional rate hike, but, we'll write down another forecast, as you know, in December.
Thank you, Chris Rugaber at Associated Press. Well, since the last meeting, the auto workers strike has finished. Oil prices have leveled off. And yet, on the other hand, you have the outbreak of war between Israel and Hamas. How do you see all those factors taken together affecting the economy going forward? How are you thinking about those?
So there are significant issues out there. As you point out, global geopolitical tensions are certainly elevated, and that goes for the war in Ukraine. It goes for the war between Israel and Hamas. We're monitoring that. Our job is
All
to
right.
monitor those things.
My order was executed.
Implications. So the UAW strike, as you point out, is appears to be coming to an end. Oil prices have flattened out. They haven't gone down, but like I said, going down a little bit from their earlier peak. Another one is the possibility of government shutdown. We don't know about that one. So there's plenty of risk out there. But I would go back to the bigger picture from our standpoint is we've got a very strong economy, strong labor market, making progress on the labor market, making progress on inflation. And we're very focused on getting confident that we have achieved a stance of monetary policy that is sufficiently restrictive. That's really our focus.
Great. And just one quick thing. You last month had gone to York, Pennsylvania, where you talked to last month, where you talked to a lot of small business owners. Just curious, what sentiments did you hear from them, or what did you picked up on, and was there anything that surprised you the most in terms of what they talked about?
I wouldn't say I was terribly surprised. I was very impressed by York as a town with a real strategy, and I would say it's very impressive what the people there have put together in the face of some difficult longer run trends about offshoring of manufacturing and that kind of thing. They've done a great job as a city, I think. What you hear and is consistent there, which is people
There we
are
go.
really suffering under high inflation.
I hope you guys got in at 42.32 with me.
Feeling that in their businesses, and other people who are feeling it in their own lives as well. It's painful for people, particularly people who don't have a lot of extra financial resources, who are spending most of their income on the essentials of life. So we know that wasn't new, but that did come through very clearly in the conversations we had in York. And I walked away from that even, just thinking that we really the best thing we can do for the U.S. is to restore price stability, fully restore price stability, and not fail in that task, and do it as quickly as possible, but also with the least damage we can.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. You've spoken before about the pain that would likely be coming for the economy in order to get inflation down. But since the economy has not responded to rate hikes in ways that would normally be expected, have you changed your views on that at all, on how necessary or inevitable that kind of pain would be, say, for the labor market or overall growth?
Well, I think everyone has been very gratified to see that we've been able to achieve, pretty significant progress on inflation without seeing the kind of increase in unemployment that has been very typical of rate hiking cycles like this one. So that's a historically unusual and very welcome result. And the same is true of growth. We've been saying that we need to see below potential growth, and growth has been strong, but yet we're still seeing this. I still believe, and my colleagues, for the most part, I think still believe that it is likely to be true. It is still likely to be true, not a certainty, but likely that we will need to see some slower growth and some softening in the labor market conditions to get to fully restore price stability. So, but it's only a good thing that we haven't seen it, and I think we know why. Since we lifted off, we have understood that there are really two processes at work here. One of which is the unwinding of the distortions to both supply and demand from the pandemic and the response to the pandemic, and the other is restrictive monetary policy, which is moderating demand and giving the supply side time to recover, time and space to recover. So you see those two forces now working together to bring down inflation. But it's that first one can bring down inflation without the need for higher unemployment or slower growth. It's supply side improvements like shortages and bottlenecks and that kind of thing going away. It's getting a significant increase in the size of the labor market now, both from labor force participation and from immigration. That's a big supply side, gain that is really helping the economy. And it's part of why GDP is so high, is because we're getting that supply. So we welcome that. But I think those things will run their course, and we're probably still going to be left, we think, and I think, still be left with some ground to cover to get back to full price stability. And that's where monetary policy and what we do with demand is still going to be important.
Against that backdrop, if you've gotten any clarity on lags, if you have an economy that's been so resilient to high rate increases, does that suggest to you that there isn't necessarily this huge wave of tightening that's still coming through the pipeline and that it may have already come into effect?
I continue to think it's very hard to say. So it's been 1 year at this meeting. 1 year ago, this was the fourth of our 75 basis points hikes. So that's a full year since then. I think we are seeing the effects of all the hiking we did last year, and this year we're seeing it. It's very hard to know exactly what that might be. But you could, for example, an example where you wouldn't have felt this yet is debt that had been termed out. But it's going to come due and have to get rolled over next year or the year after. So, and there are little things like that where the effects are just taking time to get into the economy. So I think we have to make monetary policy under great uncertainty about how long the lags are. I think trying to get a clear answer and say, I'm just going to assume this is really not a good way to do it. And this is one of the reasons why we have slowed the process down this year, was to give monetary policy time to get into the economy. And it takes time, we know that, and you can't rush it. So slowing down is giving us, I think, a better sense of how much more we need to do if we need to do more.
Michael McKee from Bloomberg Television and Radio. I'm trying to connect the dots here. One quick clarification I want to ask about Rachel's question is, you said you need slower growth. You had always said before a period of lower than trend growth. Has that changed? And two, it sounds to me like you're basically saying here that the dot plot's out the window, that every meeting is live with the possibility of a rate increase for right now. It doesn't matter about the turn of the year, and that there's not an objective way to determine whether or not you've got enough tightening in the system. It's just going to be a subjective judgment meeting by meeting.
Well, so let's talk about the dot plot first. So the dot plot is a picture in time of what the people in the committee thinks is likely to be an appropriate monetary policy in light of their own personal economic forecast. In principle, when things change, that's not like a plan that anybody's agreed to or that we will do. That's a forecast that would change. For example, many things could change that would cause people to say, I wouldn't write down that dot, 6 weeks later. Think of the number of things that could change your mind on that. So I think the efficacy of the dot plot probably decays over the 3-month period between that meeting and the next meeting. But nonetheless, it's out there, and we do personally update our forecast, but we don't formally update the dot plot. So, I think we try to be as transparent as we can about the way we're thinking about these things. We're laying out there our thinking, and as we approach the meeting, we'll all be, my colleagues and I will be talking about how we're processing that data. In terms of, we're not really changing the way, in terms of growth, what I said was below potential. So what you have here recently is growth that is temporarily, potential growth is elevated for a year or two right now over its trend level. So the right way to think about it is what's potential growth this year. People think trend growth over a long period of time is a little bit less than 2%.
Yes, stop loss is still at the high today.
But what we've had is with the improvement in the size of the labor force, as I mentioned, through both participation and immigration, and with the better functioning in the labor market, and with the unwinding of the supply chain and shortages and those kinds of things, you're seeing actually elevated potential growth. There's catch-up growth that can happen in potential, and that means that if you could be growing at 2% this year and still be growing below the increase in the potential output of the economy. I hope that's clear. That's really what's going on. That's why I would say it as below potential.
But if you could clarify what I asked about meeting by meeting, are we essentially now supposed to assume that it's a meeting by meeting, live meeting with a chance of a rate increase that will be decided on subjective criteria rather than objective at each meeting?
Here breaks. Stopped out.
I mean, I don't know that I want to just accept anybody's characterization of it. I'll tell you how we're doing this. So we're going meeting by meeting. We're asking ourselves whether we've achieved a stance of policy that is sufficiently restrictive to bring inflation down to 2% over time. That's the question we're asking. We're looking at the full range of economic data, including financial conditions and all of those things that we look at. And then we've come very far with this rate hiking cycle, very far. And you saw the spread at the September meeting of, it's a relatively small spread of people think 1 or 2 additional hikes. So you're close to the end of the cycle. That was an impression as of a belief as of September. It's not a promise or a plan of the future. And so we're going into these meetings one by one. We're looking at the data. As I mentioned, we're also, we're being careful. We're proceeding carefully because we can proceed carefully at this time. Monetary policy is restrictive. We see its effects, particularly in interest-sensitive spending and other channels. So that's how I think about it.
Thanks. Hi, Chair Powell. Neil Irwin with Axios. In light of the run-up in long-term yields we've seen the last several weeks, have you given any consideration to the pace of your asset runoff program? And if there were a judgment that the higher term premium was endangering the dual mandate goals, would that be reason to think about slowing or suspending QT, or should we think of that as more of a technical question around reserves?
So committee is not considering changing the pace of balance sheet runoff. It's not something we're talking about or considering.
All right, guys, that's going to be it for me for today. Yeah, it's all right. It happens. So that's it for me today. I'll see you guys tomorrow. Have a good remainder of the day. I'll catch you guys mañana.
In reserves.
Peace.
It's not. I think it's hard to make a case that